Hi, welcome to this eMentor 5-minute tips video on credit score basics. So the idea of this series of videos is providing useful information within 5 minutes, or around 5 minutes, that you can then take to use in your business and help further your mortgage broker career in Canada. So here's just some basics of what makes a credit score. And this is data from Equifax as well, so you really understand what comprises a client's credit score. You can really educate them on this, and it really helps broaden your knowledge as well, and just a bit of a basics of understanding, what makes a client's credit, and so you can really understand what they can do to improve it. If you need to coach clients over time on how they can get their credit in a position where they're able to proceed in purchasing or whatever they're looking to do. So here the graph on the right shows a breakdown of what comprises a client's credit score from Equifax. So you can see the biggest segments here are payment history. So what this means is, have the clients been making their payments on time? How their credit's been repaid? Do they have late payments or anything like that? And the type of payments here can make an impact as well. So lenders will often look at the payment history, and they much prefer if it's a missed payment on a phone, for example, than on a mortgage. So if it's a sort of borderline one, that's key to look at as well, the types of payments, if there have been any missed payments. And then credit utilization. So this is a really big factor. 30%, a third of someone's credit score, is how much are they using of their total available credit. So if a client is using a lot of their available credit, then this is seen as a negative from the lenders, and will negatively impact their credit score. Whereas let's say they have a line of credit, a few credit cards, they're not really using them, they're using one of them. This is actually good for their credit score because it shows they have a lot of available credit that they're not using. So when it comes to percentages, there's not a specific number here, but you'll be able to tell, as in if a client's using 80-90% of their credit. If their utilization is over their limit as well, this will negatively impact the credit score here as well. And then next, credit history. So how long have their credit accounts been in existence? So one key thing here, so this is 15%, so still a decent amount of someone's credit score. So one key thing to note here is a client's credit history is built on their longest standing account. So let's say they had a credit card when they were first building their credit score, and then they cancel that card. The history will then reset to the oldest existing credit line on their account. So this may be fine if they've got lots of credit lines that have been there for quite a while, but let's say if they're new to Canada, for example, I went through this myself when I moved to Canada 7-8 years ago or so. I cancelled my first credit card, then my credit history really suffered because it was laid back to that first credit card. So try and keep or advise clients, especially if they're new to Canada, to have their first credit card, try and have that as a no-fee credit card, or one that even if you don't use it, just keep it open because your credit history will be tied back to that credit card. And then next is public records. So this is, and this can be a significant impact as well. It says 10% here, but if someone has a consumer proposal, bankruptcy, or anything like that as well, I mean, often these will go alongside that, but lenders will look at these as well, and some won't lend, or there'll be different lending criteria, or there's different requirements in regards to this. It may have to be cleared for a certain amount of years or anything like that as well. So it will usually say if there's a prior history, if there's been a bankruptcy, a collection, or a consumer proposal, or anything like that as well, that is a big negative, and may impact them being able to get financing with A lenders. And then inquiries. So this is probably the one, even though it's small, this is probably the one that we as mortgage brokers get asked about the most. So, will it affect my credit if you're running a credit pull? So firstly, it's a very small impact on your credit score. Also, when people are inquiring for a mortgage, multiple credit pulls for mortgage purposes within 30 days are just counted as one. So the key thing to educate clients is the reason this is part of their credit report is lenders don't just want to see that they're not applying for lots of different types of credit at once. So let's say they don't have any credit lines, but then they're acquiring for a mortgage, a line of credit, a credit card. They're putting lots of inquiries out there at different institutions for different lines of credit. This is seen as riskier. However, if they're shopping around for mortgages, this shouldn't be a detriment, and unfortunately it isn't. So you can explain, if they're worried, oh, my bank's already pulled my credit, will it affect it if you pull it as well? That's not necessarily a negative. So, and even if it did impact it, it won't impact it significantly. It's a very small portion. So essentially clients don't need to be concerned about this. So I hope this gives you a bit of a background, what actually makes clients credits, what you can advise them, how you can help them improve their credit. Again, any questions, any thoughts, do comment below, and hope you enjoy the video. Thanks.